Hey friends, welcome back to the channel. So what do you do when you're about to retire and cash out? You might have a large pension that you've worked for all your life. You might also sell a property and take those proceedings and invest it. But where would you put it? This video we're going to have a look at annuities and if you should consider them. We're going to have a look at how insurance companies invest. And we're going to have a look at single premium products and why I think they're better. Let's get started. So the example we're going to use is actually from one of my clients. My client is age 48 and he's actually looking to retire. He's looking to pack it up and go home, as they say. And he has a property that he's going to sell. He has a superannuation or a retirement fund. Both of those add up to about 1.6 million US. And so he actually went to search for annuities, and the annuities from different providers roughly could give him about $5,000 US per month or about $60,000 per year. And he basically approached us and said, could you do better? And if this is a good way to do it. And so we actually did a bit of due diligence, had a look around, and some of actually the single premium products could give him about $6,500 a month or $77,000 a year from actually the second year to age 95. So the total withdrawals is actually much more. It was about 3.5 million. So about 2x of what he actually put in. So just by choosing a different product, in this case a single premium product versus an annuity product, we were able to actually get 20% more. And so actually, before we dive into the considerations with this, we actually have to know why we need to invest first. So let's have a look at that now. So if you're looking for a very low risk and very guaranteed type of retirement income setup, chances are you're not going to be doing this yourself. You're going to be delegating this to a financial institution via an investment product. And the key to investing is actually to prolong harvesting from an asset that you've acquired. And you can only do this by investing, having it compound over time, so that we can actually acquire and withdraw from this asset for a longer period than if we didn't invest. So now that we know we need to invest to prolong an asset so that we have more at the end of the day, do we choose an annuity plan or do we choose a single premium investment? Annuities are generally lower risk, but lower risk actually means a lower return. The guaranteed portion is actually quite high relative to the non-guaranteed portion. Generally, the rate of return is about 3%. And they have different policy schedules where the withdrawals are indexed to inflation a little bit, so you get a little bit more as the policy progresses, but basically it's just a withdrawal schedule. So should you consider this kind of plan or a lump sum plan? Well, for that we actually need to look at a few things. We need to look at how accurate the numbers are in the illustration document that you're given. You need to have a look at when your break even is. You need to get a feel of if those figures are too conservative. And also you need to look at if you surrender, are there any break clauses or penalties? And for that, we need to know how the insurance companies invest. So the insurance industry is extremely regulated. Each insurance company has an actuary department, which basically looks at statistics. It looks at medical claims records, risk, geographical risk, age risk, gender, job risk, etc. And then basically it produces a framework for a different group or groups of products. We also have reinsurers that act as a second insurer to the insurance company to take on its risk. But specifically to investments, there are a few key concepts that one needs to understand. After all, you are delegating that responsibility for that growth to an insurance company. The first is actually, there's always a regulating body that regulates and governs where the insurance company invests the premiums from all its policies. And this is generally an SFC, a Securities Futures Commission, that overlooks this. They can't just invest in anywhere. There has to be a certain type of investment, such as fixed income or AAA bonds, investment grade bonds, things that are very, very solid. And secondly, there's a piece of legislature in government that basically says insurance companies cannot go bust. They can't just disappear. All the policies have to remain intact. They can only be acquired or rebrand. And so basically there's a bit of a solidity and confidence in the system. So next is actually where the insurance company invests the premiums, invests the money. And basically, if we have a look at an investment fact sheet from an insurer such as FWD, we can see that everything is basically diversified. We have a look at it's diversified in industry and geographical breakdown, the different AAA bonds, AA bonds, BBB bonds, as well as equities as well. It has a look at for each of these cohorts of money that it has. It can invest in fixed income type securities and equity type of securities, generally between 30 to 50% and then 70 to 50%. It can vary that allocation as it sees fit to basically increase performance. But there are two key things that are different to the insurance realm than to other investment vehicles, and that is actually the words smoothing and fulfillment. And if I can just maybe quote that here, there's actually a smoothing process which aims to deliver more stable dividend bonus payouts during the policy term. What that actually means is they can hold back a portion of the gains that they've made or losses when the financial performance is better or worse than expected, and then pass that back on to the policy for the future years to ensure more of a stable dividend bonus payout. So this is for smoothing. This is actually quite important. What this means is, let's say they make 5% in 1 year on their portfolio, fixed income and equities. It then hands out, let's say, 4% to your policy, because actually that's what in your policy you've signed for that in the illustration. So you're expecting 4%. Next year, let's say they only make 3% because of a downturn, but you're still expecting 4%. So they will try and hand you back that extra 1% from the preceding year, which they have actually held back, and so on and so forth. So there are minor adjustments, but it will generally be quite smooth and predictable. So that longer run, when you actually compound on each year, your projections are not that far off. It's not 100%, but it might be high 90s, if not quite accurate in that regard. So this smoothing, they talk about this dividend and bonus philosophy. It's basically approved and reviewed by their board of directors. And to maintain fairness to policyholders, they may have separate different generations of policies or products with different buckets, with different dividend bonus scales, with the aim to more closely reflect the underlying financial performance. So all of these companies have a dividend and bonus declaration philosophy. So they would basically say how much was credited to this policy that year. They would actually give you a formal notification. And everything is tracked, everything has a track record on this. So for the fulfillment, which is equally important, fulfillment ratio is how well are they actually fulfilling those numbers that you see on the illustration that you're given. Numbers on a piece of paper are just numbers on a piece of paper, but if they're actually not fulfilling the dividend amount or the actual number, it's not projecting for you properly. So this fulfillment ratio is very, very important, and not all insurers are the same. For example, here it will say one of its products called Max Focus in this case was fulfilling 103%, so that maybe there's a little bit more that they could give that year. We have a look at this, and we have a look at, each of these products has a fulfillment ratio that is posted on the websites of these insurance companies. So that is actually very, very important. So you have smoothing and you have fulfillment ratio. So this brings us to why single premium products, I think, are superior to annuity products. And there's basically three reasons: better performance, reliability, and flexibility. So in terms of better performance, out of all the products that the insurance companies have, generally the ones that are single premium investments perform the best. And what I mean by this is actually that they are quick to break even. I mean, it won't be 1 to 2 years because simply the insurance has to take the money from that cohort and actually invest it and wait for that to realize and then provide the dividends or the interest to the policy. So it won't be 1 to 2 years. But what we're talking about is a quick break even might be 4 years non-guaranteed and 6 years guaranteed. How accurate is this? Well, you have to then go back and look at the fulfillment ratio, and if they are fulfilling at 100% or 101% for the first 3 to 4 years, generally this break even will happen. The projection on that piece of paper, on that illustration, will happen. So that's one thing to note. With reliability, after having explained the concepts of fulfillment ratio and smoothing, you now have a very accurate document for the years ahead. So accurate that you could probably predict within 5 to 10% of what it's going to be at for many, many years down the road. But first, you need to choose an insurer who has a very strong fulfillment ratio. As well with reliability, insurance companies are generally quite strong. They're stronger than banks. So we've seen banks go bust, but insurance companies not. And your policies are even regulated by the authorities and by the governing bodies. All right, and the last part is flexibility. You don't have to allow an annuity plan to sort of dictate when you take your money. With a single premium plan, you dictate when you want to take your money, and that money that's not taken is basically recompounded for the next year for future growth. But the money that is already taken, you can actually have policy reprinted such that you have an accurate prediction from that year forward. So these are the 3 key reasons why I think a single premium policy is actually more beneficial than an annuity policy. So thanks for making it to the very end. We hope you learned a little bit about fulfillment ratios, how insurance companies invest, a little bit about annuities and what you should consider, as well as single premium products. We've actually had another video on why we think single premium products such as this one are actually the safest investment, so you can check that out. But if you found our content useful, please give me a like and a subscribe. That would really help the channel. And I hope to see you in the next one. Thank you.